Hey there, everyone. Welcome to the Final Barts Friday, August 2nd. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com and coming to you once again from Las Vegas here at the Money Show. We're on location and meeting a lot of great people. Met a number of viewers here in the last couple of days, getting ready for a interview on stage with the great Mary Ellen McGonigal, one of our StockCharts contributors. We were planning on actually doing that show as the show today. Given what's happening in the markets, given some of the challenges of logistically of recording that event, we're actually going to be recording that event today after the close. We'll share it with you as Monday's show. And today, just giving you a quick afternoon recap on where the markets are at. So a little earlier than normal, but I feel like we've learned a lot so far here in the first 6 hours or so of trading. You know, as we talk about the market environment here, going to quickly to the market update, I will tell you that, of course, interesting follow-through day today, right? I mean, I think this week could have gone one of two general ways, either with all of the technology earnings and Magnificent Seven earnings, with the Fed meeting earlier this week, with the economic data that came out through the course of the week as well. This could have been a big rebound week where all the evidence pointed to optimism of the Fed lowering rates, optimism that what the Fed has done to date has been well received, optimism on earnings that these big mega cap companies were just in a brief pullback before resumption of their previous extended uptrends. We are seeing the opposite. We're seeing the market through the course of the week, particularly post-Fed, very much in a risk-off feel. We're seeing volatility pop to extremes. The VIX is now over 20 in a big way here in the afternoon on Friday. We're seeing the major averages continue to deteriorate with the NASDAQ down over 2.5%. And we're seeing, all the signs of a corrective environment really pointing to recessionary fears and really being magnified with risk-off movements in stocks. The S&P for now is down about 2%. The NASDAQ composite down about 2.5%. Again, a lot can happen in the last hour and a half of trading, but that's kind of where we're at here around 2:30 p.m. Eastern. Small caps, while have been an interesting, potentially interesting opportunity. And we've talked a lot about the upside potential of small caps, given the environment of lower rates, given the environment of the dollar, and just and how much they've lagged behind. They are selling off in a big way too. Pretty much everything rotating lower, except for other areas of the market, except certainly for defensive areas of the market. Your top performing sectors today are all defensive. So let's continue on here. The VIX for now well above 20, currently just above 25. We're seeing interest rates come down with the 10-year yield currently as we're recording this around 3.8%. Bond prices and bond proxies are going higher, meaning people are looking for the relative defense of high-yielding bonds and high-yielding stocks. The dollar is actually moving slightly lower. Commodities, generally speaking, are slightly lower. Cryptocurrencies kind of going in concert with the S&P 500, sort of in a risk-off mode. Bitcoin currently around 63,000. That's down another 3.5% from Thursday. Looking at the 11 S&P sectors, we're seeing staples, real estate, utilities as your top three performers. So again, we have defense at the top of the list. On the bottom of the list, again, here in the afternoon, we have consumer discretionary and technology, two of the three sort of FANG sectors. So the utilities and real estates and staples, which are your higher yielding, lower volatility, more defensive posturing type of sectors, are appearing to show quite a bit of strength here. Looking at the Magnificent Seven, we're going to actually get into a little more detail. I do want to point out that Apple is actually up 2.5%. We saw that with Meta gapping higher on earnings earlier this week. We're seeing that with Apple trading higher on earnings. And the problem is it's just not enough to stem the tide of defensive positioning or defensive rotation that we're seeing. Here's what the chart of the S&P looks like here. We're touched 5,300, which is basically retesting the May peak. I would say also the problem with today's action, again, barring a huge rally going into the close, is now I would say we definitely are getting that follow through. We're getting a follow through after the break below trendline support. We're now getting a break below the 50-day moving average. We're now getting a close below 5,400 for the first time since early June. We've talked about being in the line in the sand which I think is a concern that we're breaking below there on weaker momentum. So I have 3 alerts that were triggered on the top of my StockCharts login when I first checked in today. The one was the S&P breaking below 5,400. The second was the VIX popping above 20. The third was Amazon breaking, I think, 160, whatever key support level I was looking at. So overall, and I'll be talking with my Market Misbehavior Premium members over the weekend, going a lot more in depth into some of these themes, but this is sort of where things are looking right now. The VIX all of a sudden looking very much like a correction sort of range, right? VIX below 20, but above 15 for me is pullback mode. VIX above 20 is correction mode. VIX above 29 is disaster mode. That's your doomsday scenario. And that's not too far from where we're at here with the VIX around 2550. Here on Friday afternoons. I think going into next week, a lot of questions will be and should be asked about the elevated volatility and what that actually means. I would say that means we're sort of in a risk-off environment, and certainly you're seeing high yield spreads widening out. I don't have the number for Friday. That will actually come out. We'll be able to register that over the weekend, but generally speaking, I would expect spreads which have been widening through the course of this week, widening even more, and that tells you bond investors are getting more risk averse or recognizing elevated risk in the market. Worth noting, though, even with today's sell-off here through the afternoon on Friday, the VIX for now is still above 50% of stock, or sorry, not the VIX, the percent of stocks above their 50-day moving average, still well above 50%. Not that much, right? It's, 5 points, 6 points above there, but still more than half of the S&P is above their 50-day. So while the S&P has broken the 50-day, while a lot of the FANG stocks, the Mag 7 names are deteriorating, there are plenty of things that are still actually doing quite well. I'll show you a chart of a technology name that's actually still in a primary uptrend. So they're out there. It's just not in the names that we've become accustomed to. Looking some of the FANG stocks, I would say Apple, again, for now, up about 2.5%. You're seeing Apple continue to outperform, maybe putting in a higher low around 215. It was a good earnings report. Again, the challenge is just how much do people want to own more Apple here, given the fact that everything else seems to be rotating lower. Most of the Magnificent Seven stocks look a lot more like Alphabet, which is actually, making a lower high and now potentially making a lower low through the course of this week. Microsoft, and now the 200-day moving average is in play. When I think about individual stocks to pay attention to, I would say Microsoft is one of those top of mind where we're testing 400 to 410. This is the 200-day moving average. This is a 38.2% retracement of the late 23 low, the July 24 high. 38.2% of the way down is around 407. That is where we are trading right now. So if Microsoft is going to bounce, I would expect it to be at Fibonacci support at the 200-day moving average as we're oversold, testing the May low. This is kind of that point. The problem is if that doesn't hold, and if next week we continue below there, this all of a sudden, I would argue, unlocks much lower objectives for something like Microsoft. Think about what that means for the NASDAQ 100, for the XLK, where Microsoft is obviously one of the biggest weights. For the S&P, it's a $3 trillion market cap company and obviously one of the biggest weights in the S&P. So what is working, right? So not all of those technology, and sorry, I mentioned technology. GoDaddy is actually in communication services with some of the other internet sort of website names. If you look at GoDaddy, it's actually up another 7%, making a new all-time high today. So what I always caution people is when you get this big risk-off signal for stocks, I am not a fan of just selling with no compassion and with no awareness, right? I don't think the market, as measured by the S&P or the NASDAQ, breaking down through support means you just unwind positions just because. I would argue that it's always a good time to own good charts. So if a chart like GoDaddy keeps going up and keeps making a pattern of higher highs and higher lows, I want to keep holding those trends as long as they continue to be described that way. Look for unwinding charts like an Eaton Corp or other names where the uptrend is clearly no longer in play, where we're not holding support but breaking support. We're not holding an ascending 50-day, we're breaking an ascending 50-day. Those are the signs that a trend is actually rotating lower, what we call a change of character. I would argue something like GoDaddy is still making higher highs and higher lows for now. We continue to see improvement in defensive sectors. I think that was a key story in July. I know when I did my monthly chart review with my Market Misbehavior Premium members yesterday here from Las Vegas, we talked about that rotation away from growth sectors into value sectors like materials and into defensive sectors like utilities and real estate. For now, it appears that at least early August is continuing to follow that trend of defense over offense, of value over growth. And I don't think that trend is necessarily done. Final comment to think about is just, a great opportunity to use something like the market carpet on StockCharts.com. If you've not used this before, I would encourage you to do so. What you do is you go to Charts and Tools. You will see a selection called Market Carpet on the page there. This is the vanilla color scheme, which I found I really appreciate. Neutral is basically in a vanilla kind of beige color. Down a lot is bright red, up a lot is bright green. It is very easy to find the big movers. And I would just, point out a couple takeaways. Number one, look at all the red here, particularly in some of the biggest boxes. But also note which sectors are not showing all red, right? Things like real estate and staples and healthcare, where you're actually seeing a decent number of stocks in the green. Largely speaking, I would say in any sector, look for the chart list stocks like Apple or Market Access or CBOE or RMD, ResMed or T-Mobile or Mondelez or Clorox. These are stocks actually having decent up days in the face of a major down day. Now, this is just looking at the S&P 500. You can do this with other ETFs, other groups of stocks. But I would just say on a big down day, when it feels like everything's going down, there are most likely some stocks doing just fine. Stocks that are resilient in the face of a market downtrend often can deserve a little extra attention. Folks, that's our abbreviated market recap here for the final bar here on Friday, August 2nd. Thanks so much for your patience as we work around the conference here in the Money Show. Again, if you are here in Las Vegas, make sure you say hello. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.